Last quarter, we introduced the notion of the great beta trade and the idea that the last few years were characterized by above normal returns and below normal volatility, and we expected that to change. Well, the expression is be careful what you wish for, and apparently you should be careful what you forecast, because volatility came back with a vengeance, largely on the shoulders of China and concerns there. However, investors have to remember that higher levels of volatility and meaningful drawdowns are a normal feature of markets, in particular the uptrending market we've seen over the past 3.5 decades. So speaking about China, there are questions around the currency and the equity markets, but for us it's about growth, and we're still not seeing a hard landing. But it does remind us that there are challenges across all of the emerging markets, either by way of growth or geopolitical concerns or both. So from a global growth perspective, while it's still moderate, we've been talking about and continue to believe in a narrowing of the growth gap between emerging and developed economies. At the center of the developed universe right now, the United States, and jobs and income at the center of that. This is a great chart that shows the relationship between taxes withheld, a proxy for jobs and income, and GDP. And this says there's a lot more horsepower in consumption. We're actually already seeing that in our best since chart. The past 5 quarters are the highest run rate of real consumer spending in over a decade, as are others. And job openings are at a 15-year high, also a great proxy for jobs and income. So on the world stage, moderate global growth, low levels of global inflation, and lots of policy accommodation. Speaking of accommodation, the Fed elected not to raise rates in September, but whether they start now or in the next few months, for us it's largely about speed and magnitude, and that for us is still low and slow. So for our fixed income, it's also about balancing rates and it's about balancing credit. But you know, the third quarter should have been a reminder why defensive assets are so important. Also, credit spreads widened out pretty meaningfully over the last 4 months or so, even taking out the problematic energy space. So we'd be looking to potentially add a little bit more credit into the portfolios. But regardless, we have to continue to aggressively manage liquidity, shown another way here with a higher level of markets in terms of AUM or size, but not a concurrent increase in volumes traded. So turnover is low, another indicator of liquidity. So we have to go about this both offensively and defensively. Defensively by being multi-sector or using liquidity management tools, but offensively by taking a page out of Warren Buffett's book and buying when others are fearful, or using things like private credit where liquidity premiums are the norm. Now, in equities, if we talk about rates, I think we have to really hone in more on the idea of inflation. Because as long as inflation is benign, equity markets can support a higher multiple, similar to what we're seeing right now. So the real narrative for us has a lot to do with being active. You know, in a beta trade, when multiples are expanding and markets are running up, active management doesn't do very well, but it does pretty much everywhere else. And we're already seeing that in 2015 with a lot more U.S. managers outperforming the S&P versus last year. But what about areas for the greatest opportunity for outperformance? Well, let's take a cue from moderate growth. Those that can grow well at a corporate level should also be richly rewarded. And we're seeing that as well with growth managers outperforming at a much higher rate. Now, interestingly enough, the possibility of future outperformance still is not expensive. So, in coming to a conclusion, your equity portfolio should be active. It should be focusing on characteristics that are going to give you the opportunity for alpha, but also protect to the downside. Fixed income, still balancing rates and credit, and remember, liquidity is something you have to focus intently on. And finally, if we are going to defend to the downside and capture relative value opportunities, we must have a healthy dose of alternatives going forward. As always, it's a pleasure being with you, and we look forward to seeing you next quarter.